Welcome to the Trading Bell Show. Now, Absa Kenya has released their half-year results, net earnings at 8.3 billion for the half-year ended 30th June. I'm speaking to Abdi Mohamed, the CEO and MD Absa, to demystify for us the key performances on these impressive results. Abdi Mohamed, welcome to the show.
Thank you very much.
And good to have you. And I should start by saying, first of all, welcome to Kenya. I had the financial officer telling you the same thing. So welcome to Kenya. You have hit 100 days.
100 days on the roll, yes. And going strong.
Yes.
Enjoying the new role.
Yes.
And a lot to do. I've been to different parts of the country.
Okay.
Excellent opportunities.
Wow.
And, we're really looking forward to the rest of the year.
Excellent.
Yeah.
And first, let me congratulate you on the half-year results. This is quite commendable. And we have seen what you've done, 8.3 billion for the half-year ended 30th of June. And my first question will be this. What are your key driving forces that you have seen that have driven this performance?
Thank you. As you say, it's a strong set of numbers. We're really pleased at where the first half has landed. Strong revenue growth, 31%, driven by both balance sheet numbers growing, assets and liabilities both double-digit growth, but also driven by what we call capital light revenues, new businesses such as bank assurance, the custody business, a number of new areas that we have gone into starting to show significant growth and contributing to the bank, but also driven to a large extent by prudent management, within what is essentially a fairly dynamic macro environment, and ensuring that we manage costs, we manage impairments well, but the biggest driver by a mile is really the revenue growth that has come through in the first half of the year, and really pleased with the strong performance as well.
Wow. And we wish you well. I'm sure there's be some good news for the shareholders and investors, definitely. But before we get to that messaging, the current environment that we are operating in, a lot of sectors have been saying it's quite a tough one. And for example, looking at the bill that just passed, the taxation regime that is around, and of course some critics also have that there are some positives in it. But you have done what you have done. What is in your part? What are you seeing from the customer in terms of the challenges facing the ecosystem around their operation?
Yeah, so it's a mixed picture.
Correct.
And people always pick the 3 or 4 big negatives and focus on it, but it's a mixed picture. The GDP growth in Kenya is still north of 5% in terms of projections. It's well above the Sub-Saharan Africa average, and also well above global average. Certain sectors of the economy are starting to show traction and growth. We're seeing agriculture making a strong recovery, and having a positive impact on inflation. We're seeing the tourism and travel recording one of its best recent years. We are seeing diaspora inflows increase significantly, and so there are certain sectors that are driving the economy. But on the reverse side of it, we see the discussions around cost of living. We see the discussions around inflation, although it's coming down and coming back into the target range. And therefore, at the end of the day, when you're running a financial institution like we are, you're looking at that full picture and saying, how do we manage the risk? How do we help our clients manage through this cycle? But how do we at the same time ensure that wherever there are strips of opportunity, that we are taking them on behalf of our shareholders and the wider stakeholder base? And how do we play our role within that macroeconomic growth? How do we drive the economy? How do we do our share of driving the economy? And therefore you will see that, sometimes when we talk about balance sheet growth, it's just might be viewed as numbers. But these are clients, these are businesses,
Yes.
these are Kenyan entrepreneurs out there that we are putting balance sheet out to and supporting through their journeys of growth. And therefore we view our contribution from that, wider perspective as well.
You're right. Had you speak a little bit on some of the different products you're offering, and even some of the non-funded income that is coming through from the effects of today, from some of your key areas of instruments of growth.
Yeah.
And I'm curious to ask you, what have you seen as the now looking at your numbers? What's the level of contribution to the numbers that you've seen in these areas?
So we've always been a large diversified bank with very minimal concentration risk, a book and a portfolio that is well diversified. And when we look at the opportunities for further diversification and growth, we first of all look at the Kenyan demographic, what's happening within the Kenyan market. A very young and growing population, high adoption rates when it comes to technology and digital, services. A big entrepreneurial class, young people who are going into business, into self-employment. And we ask ourselves the question of how do we become the bank of that future? So that's one big aspect of our diversification. The other side to look at is the product side of it, and I think you just alluded to that in terms of not just the core traditional banking products, but also how do we use the platform that we have as an organization to deliver more services to customers.
You're right.
And therefore become a truly diversified financial services provider. So that's another important area that we're looking at. And then when you look at the corporate bank, we've traditionally been a debt house, where we put a debt out to the market, but we are now providing a very strong transactional banking service that is, driving new revenues into the corporate bank. We are moving into investment banking, which has a big advisory, component, and that also comes with the fees and the income from that perspective. So the idea is to have a good balance between that bit of our revenue that is balance sheet driven and that bit that is capital light, the alternative revenues, and making sure that we are diversified in that respect as well. And then lastly, it's about sector diversification, where you're looking at which sectors are we exposed to, how are those sectors performing in the economy, and ensuring that the bank's portfolio is well diversified from a sector perspective, from a risk management perspective as well.
Absolutely. One of your tailwinds that you mentioned is the risk-based pricing. Of course, there were a lot of critics at first when they said, are we going back to the expensive loans and the likes? But you've seen it as a positive. How is that going down for you?
The way we view risk-based pricing is through the lens of the customer. When you are a customer of the banking industry and you are a good customer, you are a regular payer, you take facilities and you repay, that history should count for something. And from a risk-based perspective, that provides a real advantage to regular and reliable customers who then want to grow with the organization, to get pricing that recognizes that element. But at the same time, it allows the financial institution to quantify the levels of risk that they are taking, and therefore consider their pricing from that perspective to ensure that other stakeholders are also protected. So it's a very positive development for the market. And, like other players in the industry, we've received the necessary approvals and are in the process of a phased, implementation to ensure that we get the benefit. But I really want to repeat that for us, we look at it from a perspective of the customer and how to make it work for the customer. Because at the end of the day, we want our customers to grow. We want our customers to have the ability to repay, because it's only by doing that that the risk-based framework really works for both the bank as well as the customer.
Absolutely. And you're right, I have seen it done in other countries as well. Still on the subject of risk, looking at your numbers, loan loss provision up to 3.3% from 2.3%, that's 1% up. And of course, non-performing loans 7 to 9.2. Of course, still in the industry standards. But what are you seeing in this? Are customers struggling? Is the environment a bit tough?
As you say, the loan loss ratio, the NPL numbers that we've put up in our H1 numbers are still far lower than the industry averages that are out there. And this is primarily because of what we do on the policy side, during the underwriting when we are getting customers on board, ensuring that we are taking the right decisions that are taken both on behalf of the bank as well as the customer, and making sure that the quality of the book therefore is good. And secondly, it's driven by the engagement that we have with the customer. In those moments, and in business those moments are there, where the customer struggles to repay. How do we support them through that period? And I still meet customers in my travels who remind me of what we did for them during the COVID period, and how we helped them to weather that period. And so that's another aspect that really helps us as a bank in terms of managing the NPL levels. And as the economy goes through its cycles, customers will experience challenges. I think the challenge for us as a banking industry is how we work with our customers through that period, and how we continue to reduce the NPL numbers, as we move forward.
Still on your books, your efficiency improved by 37%. What have you been doing?
Cost income ratio 37%. It's really, not just leading from a local market perspective, but world leading as well when you look at the global averages of that number. I think that there are two drivers. One is our revenue has been growing, and this is a ratio. We've grown revenue significantly. But secondly, we've done a lot of work on the cost side of the organization, and therefore the efficiency levels are quite high. We've invested in digitization. As we presented out there, 90% of our transactions are happening outside the branch network, and therefore the more you invest in digitization and the more you scale that side of the business, the more the efficiency number improves. But as we were saying, it's also a number that should move around depending on the investments that we put in. So we're just getting into a horizon where we will be investing heavily onto the digital side of the bank, and therefore you might see slight movements in this number going forward. And it's not just about driving it down and down and down. There is such a thing as a healthy cost-income ratio where you are driving efficiency, but also to the extent possible, you are taking those investment opportunities that are there so that you're also investing for the future.
Oh, great. 2 weeks back, the Interbank Corridor Framework was introduced by the central bank. And, they set their CBR. My question to you is, how are you receiving this? How is it on your end?
The corridor framework has been very well received by the industry. It's a very positive development. As you know, the central bank guides the market through the instruments such as the CBR rate, which is regularly communicated. And one of the things this framework does is that it makes that CBR guideline, the transmission of it into the industry become a lot more solid, because it presents a corridor within which the rate environment operates around the CBR rate. And the new governor, since he has come on board, and our new deputy governor have done a lot of engagements with the industry, and Absa has participated in many of those forums, and some of these measures are coming out of those engagements with the industry, and have indeed been very well received. So it's a new framework. It's the early indications are that it works, and it works positively for the industry. We continue to work with the central bank to see how to make it even more effective.
Okay. As we come to a tail end of this conversation, I'm keen to ask what's in your purview when you look at the future. I know you have really done super well in terms of your strategy. So what's next? What's coming?
I think, if you look into the future, you're talking about positive transformation of the organization. You're talking about maintaining the momentum, this strong set of numbers that we have shown here today, ensuring that momentum is maintained, investing in digitization, which is really the future of banking, partnering, especially with the fintech community, expanding into the SME sector and driving that part of the business, significantly, increasing our scale and reach in terms of the branch network, the agency banking part of it, and these fintech and digital partnerships across the board as well. So that is what you see. You see a bigger, scaled up organization that is increasing revenue, increasing balance sheet, and becoming a more customer-centric organization. That's solutions for the customer. Because the more we solution for the customer, the more our growth and sustainability is assured as an organization. And a place really where, for colleagues and the staff of Absa Kenya, a place where they want to stay and work, and a place where those that are outside want to come in. So that is the future that we see.
No, you're right. And I remember you're accredited and certified by a top certifier, that you're top employer, I think 2 years in a row. Congratulations on that.
Indeed, and we want to maintain that, as we move forward.
And I can't leave you without asking you this question.
Yes,
I know your peers will be really keen to listen to this. What's competitive advantage?
Customer centricity, focusing on the individual customer. Sometimes when you're running a large financial institution, it's easy to get lost in the numbers and the strategies and the big things. But I think so long as we are solutioning for each individual customer, and every client you meet out there has their own story, they have their own ambition, they have what they want to execute. If we are able as an organization to provide that solution, then growth and sustainability is assured. So for us, that focus on the customer, that obsession with the customer, is the thing that will differentiate us from everybody else.
Lovely. And your last final message to shareholders who are watching?
I would say that they should look forward to sustainable growth. The bank has a sustainability agenda that is a core part of the strategy. We're delivering strong results in the short term. We'll deliver strong results in the medium term. But even today, we are working on the transformation plan that ensures the sustainability of those results. So outperform is a word you hear a lot in Absa corridors. It's about outperforming our plans. It's about outperforming the market, and it's about ensuring that outperformance is sustainable over a period of time. So that's what they should look forward to.
Okay. Congratulations once again.
Thank you, MC.
All right.
That's
Abdi. Mohamed is CEO and MD, Absa Bank Kenya. Very optimistic and even a good message to the shareholders that listen, we are here to outperform, and that's good news for you. I leave you now with the markets.
NSE has recently released its half-year results, where we recorded a 72% growth in profit after tax. These results really attest to the fact that the exchange has demonstrated resilience once again in the face of such difficult times. Now, the key drivers to this great performance has been our growth of our data revenue. It grew by 31%, and here we saw an increased uptake of our data sets, especially by the international banks and our vendors. We also saw growth in our equity turnover, largely driven by a huge block trade that took place early in the year and continuous trade by institutional investors. Our investments in the regional markets also continue to contribute immensely to our performance. We saw an increase in our profitability from our investment in Dar es Salaam Stock Exchange, and this just demonstrates that our regional strategy is actually progressing extremely well. On the expense side, we saw marginal growth in our expenses, which again attests to the fact that we've been undertaking a very stringent cost containment measure to just ensure that we invest or we spend in high return lines and just manage the rest of the business within set budgets. Our outlook for this particular second half of this year is that it remains fairly optimistic. We are very keen on getting new listings onto the market. We are keen on the uptake of our new products, especially the real estate investment trusts and ETFs, and also on enhancing the uptake of our Ibuka and NSE Connect platform, which mainly targets SMEs. I think as we continue engaging with government on privatizations, we want to also make sure that on the private sector, we keep our engagements alive, especially around equity listings and bond issuances. So with that, we anticipate that this could be a good year for us compared to last year, and we're putting all our energies to ensure that we deliver on the set budget for the year. Thank you.